How you doing?
Hi,
How you doing?
uh, I'm doing great. Thank you so much for joining. I don't know what happened. My other phone, Instagram just kept blocking me from going live, so I had to quickly log into a new phone. Thank God for
Great.
that.
Can you hear me well, or do I have to wear the headphones?
I think I can hear you perfectly well. If everybody can hear you well, just do like a thumbs up sign in the comments there. If you can hear him very well, just do a thumbs up sign. Just add a thumbs up emoji. We'll just hope everybody can hear us. Okay. Awesome. Thank you, Bolu. Thank you, Oluwa Mayowa. Thank you, guys. Okay. So, thank you, ADBC. All right. So, I have a very interesting guest here today. We were supposed to do this before, but something just happened. I don't even know what happened. And we couldn't make it the last time, but thankfully we're able to do this today. And we're basically talking, financial security. And my guest is the amazing Kalu Aja. I hope I pronounced the name correctly. Is that the okay? Awesome.
Yep, you got it.
Okay. So I would love it if you could start by telling us a bit about yourself and what you do, and your I don't know, maybe I'll say a day in the life of a financial planner. Just give us a brief about yourself and what you do.
Okay, how do I start? So my name is Kalu Aja. I call myself a financial planner. I have a day job. I manage investments for a foundation. My background has been finance, working at conglomerates, working at PFA, working in investment banking and private banking. So that's my background. But but personally, I have an affinity, or I want to basically promote financial intelligence,
Yeah.
especially in Nigeria, because there's just a big knowledge gap and people get into a lot of trouble. So I want to try to correct that. So I mean, what I do in my financial planning life is people call me or send me a message and be like, "Hey, I have a problem, and I want to translate that problem into a financial question." So someone says, "What can I do?" I turn into a financial question, and then we're able to work with the person to then get a financial solution. It's habits and it's also money. So we try to work on both of them, habits and money. You combine both of them, you're able to get things done.
Mm. So, I mean, just based off of the idea of financial planning, if you look at the idea of planning in and of itself, it's almost as if there is a goal that you are planning towards, or there's something you want to achieve. So, as a financial planner, how would you say? I would want to ask maybe on the topic of personal finance, for instance. How would you say people should? I don't know what specific money goals would you say people should set, and just basic things that you think people should set, everyone should set or should have rather, and things that you should do to get to those things, to those goals.
Yeah, great question. Um, so when we do financial planning, there's what you call a demographic target for everybody. So
Okay.
usually by your age, you have normally the same targets across the world, literally. If you're say 21 to 40, you're what we call the accumulation stage. So at that stage, you see that you earn very little, you have access to credit, you don't have a lot of assets. You're trying to accumulate assets when you start working. So when you're about 40, maybe you're unmarried, you have no dependents per se. So you're just trying to accumulate via what you earn. When you get to 45, 60, we're now what they call the consolidation phase, whereby you're trying to convert that cash flow or the assets you have accumulated. Now you're now consolidating them. And then when you retire at 65, it's what you call the spending phase, whereby those assets you've accumulated, you're then drawing them down to then live off as a pensioner. So in those three buckets, you have different objectives. If you're younger, you can take more risk. So the investments you then can take are going to be very different from the investments a 60-year-old will take. So the whole idea is to find out who you are. If I know who you are, I can tell you how you should invest, maybe recommend that to you, and then tell you the kind of risks you should then watch out for, more or less. So who you are, the kind of risks you can take, and how old you are determine a lot in the types of plans, investment that you should go into. So that's the point I make about behavior and finances. Finances itself, the products do not change, but the person changes, but we're all different. And then because you're different, that's going to determine the types and we'll say investment assets that you then invest in.
So that's interesting. Basically, who you are, what kind of risks you can take, determines who you are, and how old you are kind of determine what kind of risks you can take and how much people should invest. I know most of the people who subscribe to what I do, subscribe to, based on what I've seen, are mostly between the ages of 18 to 25 and around 35, maybe 40. So that's like the major age range for especially people that are, in this technology or digital age, that are, investing heavily in products and services and things like that. So for an 18 to 25-year-old, maybe Nigerian, who are comprised of the vast majority of this audience, how would you say they should maybe invest or allocate investments or allocate portions of income to investments? Is there like a proportion? Is there like an 80-20 rule, or what do you think is a good template that works?
Yeah, another great question. So it's going to be, I'm going to give two answers. One if you live in Nigeria, and one if you live outside Nigeria. The reason being that if you live in Nigeria, the biggest thing you have to worry about is inflation, because inflation is going to really affect where we're going to put you into, right? So if you live in Nigeria and you're a 20-year-old and you want to start to invest, there are some things you have to do first of all before you can start to invest. The first thing I'll tell you is to start an emergency fund. So before you even invest, you want to just get a bank. You're going to put cash in that bank. The amount you're going to put in that bank is going to be 3 to 6 months of what we call your necessary. The technical word is your non-discretionary expenses, but your necessary expenses that will cover, say, rent, food, gas. That if anything happens to you, you can survive for 3 months without going to work. So build that up first before you then start to invest. So get an emergency fund. If you are married, the next thing you want to do is to get life insurance, because you're not insuring your life, you're insuring your income. So should anything happen to you, your dependents then have something to go off on. So emergency fund is first, then life insurance is second, then you want to start to invest, right? So if you're investing as like I said, as a 20-year-old, you can and you should be able to take a larger proportion of risk, right? Risk assets are going to be those assets that you're not sure of the returns are going to come back to you, specifically equities. If you're buying shares, no one's going to give you a guarantee of what you're going to get back. But equities over the long term can beat inflation and can allow you to compound. So if I was a 20-year-old, I would recommend that you try to take a larger amount of volatility by buying a larger proportion of your portfolio in equities. So you buy shares, I would say 80%. The rule of thumb is you minus your age from 100. The larger proportion you put it in equities. Buy equities, reinvest your dividends, and just allow it to grow, right? As you get older, 40s, 50s, you want to start to transit back to fixed income. But I would say do a lot of equities. If I was building a portfolio, I would do foreign equities. Very, very important now that you have the opportunity to invest abroad. I would do a lot of foreign equities. First of all, I would do a bit of, so US, as I would do US about, say, 40%. I would do the rest of the world about, say, 30%, that's about 70. I will do Nigeria about 10 to 20% before I then start to do fixed income just to protect myself. 1%, 2% in crypto because it gives me some wild, risky returns. And I'm like, it's not investment per se, but you just want to be in that space, you know.
Yeah.
Your target is to appreciate your investment capital at the younger age. As you get older, you're talking about income, but right now you want to turn a 100 naira into say 200 naira, and that's going to be done over a long period of time when you earn dividends and you reinvest the dividends. So I will say take risk, buy equities, and do an asset allocation that includes America because the American market is the booming market in the world right now. And you can do that by just buying ETFs. So just Google that word ETF. If you don't know anything about investing, just go buy an ETF, BTI, leave it alone.
Mm. So, okay, that's it. That's very, very detailed, actually, I must say. So, you've touched on Nigeria, and before we go to the US side, I think that's you wanted to break it down into two. So for Nigerians, that's inflation is a major thing that we should be concerned about, which is how we all know the beginning of this year, sardine was like 300 naira, and just this year is not even over yet, and it's almost getting to 700 naira. So that's a very, very typical case of example. Bread is also another example how the price of bread has gone up. So for that
Yeah.
age range, that 20-year-old age range, start an emergency fund, like you said. That is a very, very important thing. That's the first priority. Second thing, if you're married, or I feel does this only relate to married people, like the life insurance thing? Is it for like every 20-year-old? Is that something?
If you have dependents, if you don't have dependents, you don't need life insurance. So, but if you have someone that would suffer if your income stops. So in Africa, sometimes you pay for your parents. If you have that, you want to do life insurance because you're insuring that loss of income, not the life itself. So if you have someone that would suffer if your income stops, you do it.
So life insurance. Okay. Then the third thing he mentioned is that we should take larger risks. So that's considering things like equity, because over the long run, equities can help us beat inflation, and fixed income for as we get older. But equities, the US equities, like ETFs are one of the very major examples or stable examples per se, which return a somewhat consistent percentage in APYs for number of years, and for Nigeria maybe like 10 to 20%, and then cryptocurrency, which is I like that the breakdown, and I like the way you look at it. But for people that are in the US, is there something that you wanted to touch on? I know you mentioned that.
Yeah, I think they've got more choice. They're luckier because they've got more choice. There are many ways they can invest. So they can build a portfolio. It's now the behavior, it's easier for them there. Personally, you could get like a credit card, get an Acons card. Acons is like an app. What Acons does is as you spend with your card, it rounds up your spending and it invests in equities for you automatically. So you go to the gas station, you buy gas for 9.99. It takes that 1 cent, automatically buy shares for you. So they've got lots of all these options that you can just do. So it's going to be the same thing. If you are younger, try to build a portfolio that's going to be quote unquote allow you to appreciate your assets. So your behaviors are going to be easier. You have access to credit. Try to buy a house as soon as possible because then you can ride the equity market, right? Not equity of stocks, but equity of the house. So as soon as you get in, you want to start to build very, very good credit, right? So you get a good credit score, you get a credit card, you use the credit card not because you want credit, but you want to build credit history. You try to buy a house, right? You try to lay paper trail down. You try to also invest in the equity market. You want to ride that wave as the year of compounding. So that's going to be the difference between a Nigerian-based investor and a US-based investor. The choices available to you is much, much wider in the US. In the US, you're not worried about inflation, but you're worried about returns, right? So in Nigeria, you can buy a land in Lekki and the next year is 20% up. In the US, only a few states might have that. If you buy a house, say in some states, it might not go up 5%. Houses not doesn't go up everywhere. So that's going to be the problem for them over there. The dollar, you can't put the dollar and get 14% fixed income return. Like if you go to the bank, it's 1%, 2%. So the inflation also plays down, it dampens your result. So you want to look for ways to invest. You have 401ks, you have Roth IRAs. So you want to basically do all these first, apart from the emergency fund for the Nigerian guy. You want to do in the US a Roth IRA. You want to do a 401k before you even start to even look at the stock market or personal investing. Make sure you are matching. Because the point is, you have more options, you have more opportunities, so you want to make sure that you are taking advantage of all that before you even invest.
Interesting. I like the example that you gave, and again, like the emergency fund thing. Would you say that there should be what do you think to the saying that people say, to the saying of investing or investing, maybe is it saving or investing 50% of one's income? Is that does that make sense? Or again, like you said, is it age dependent?
No, just so let's define what savings is and what investing is, right? So once you earn and you don't spend, you have saved. That's
Mm-hmm.
it. Once you earn, you don't spend, you've saved. The target in savings is your savings rate. How much of your earnings have you not spent? That's the only savings goal you want. Not the interest rate, just savings goal. How much have you stopped yourself from spending? Investing is then taking that savings and deploying it in a predetermined manner to get a predetermined result. So it doesn't matter. So if you earn $100 and you have a savings rate of 50%, that means you didn't save, you didn't spend 50 naira, right? That's all you want to achieve there. But then you want to take your savings and invest it. So no investing without savings. So people, you have to, investing is what everyone does. When you say, I want to put money in the bank to earn 2%, you're not saving, you're investing because you've taken up, you didn't spend the money, then you've invested it in a savings account. But once you spend, it's gone. But if you earn a paycheck, you don't spend and you keep the money, you've already saved. You cannot invest without learning how to save. So the behavior we talk about is teaching you how to, first of all, not spend. That's why the budget comes into being. So once you learn not how to spend or learn how to spend right, then you're on the pathway. Remember, you yourself are a brand. So you want to spend money on yourself first. You know, you look at yourself and say, I'm going to invest in myself by investing in my 401k. That's also investing. So saving accounts, all those accounts, they are all investing. Once you don't spend, you have saved. Then you don't take that savings and then invest it. Yeah.
This is actually very insightful. So I'll just go again. I'll just reiterate what you said. Saving is different from investment. Saving is once you earn and you don't spend, you have actually saved that. And one of the key, very important ways for enabling saving is budgeting and also being frugal. That is not spending wisely or not spending on things that don't really matter.
I like frugal. I like frugal.
Yes. So that's also, it entails spending on yourself first and investing, which is like developing that emergency fund or the Roth IRA, the 401k, like you mentioned, and taking that saving and converting it into a vehicle or deploying it into a vehicle that can get you returns is investing. So that's sort of the breakdown and the conundrum, just like you mentioned. Okay. Another thing I would want to go into is uh, somebody mentioned something here, which is the question displayed, and that is is there a hope for a financial breakthrough at 29? I also want to touch on the question that I prepared, which is the very first thing: people that have no experience with investing, what should they do? And I know you mentioned developing the habit of saving first, spending wisely, and then having to take that saving, deploying it in a manner that can generate returns, which is the definition of investment. But for someone who has no experience with investing, what would you say the first thing, what you say is the first thing they should do, and maybe continue?
Yeah. So, I mean, this topic is like we can do 10 weeks on this on how you should invest, the
Yeah.
way you should invest. So I would say this, right? The biggest, when you say you made 10% return, people don't understand that that 10% return is only growing because it's over time. It's not the interest rate that is growing. It's the amount of time that makes the money grow. If you go to the bank and you ask the bank, show me the formula for interest rates, they're going to give you a formula called the present value, and it's going to be compounded either monthly or quarterly or yearly. That formula, if you look at it, if you Google present value per annuity or present value per savings and all that, it's raised over time, not over interest. That's why Einstein said the eighth one of the world, compound interest. It's time that gives it return. So when you are younger, you have a huge advantage because if you put 100 naira, now I always give this example. If you take two brothers, right? One invests $2,000 a year, and they both start when they're, say, 10 years old. One brother invests $10,000 a year for the first 10 years, and then he stops investing. The other brother starts to invest the same $2,000, but they invest by the 20th year. So he starts from year 20 and invests for double the amount of time. So he invests for 40,000. This guy invests 20,000. But this guy invests for 20 years, but he started later in the year 20. The guy that starts earlier would have more money than the guy that starts later. It's not the interest rate, it's when you start. So if you start to invest early, all things being equal, you would make a better return than someone that invests later, even at a higher interest rate. So younger people don't understand investing. That's why when you get older and you get all that knowledge, you're like, oh my God, I want to go back in time and invest. But time has already passed. So you want to basically start off now. So back to your question, the best way, if you don't know what you're doing, try to buy an index fund. Just again, Google index fund, go to the S&P. The S&P means all the shares in the US market, right? So you want to buy Tesla, Microsoft, Amazon, Moderna, but you don't have all that money to buy all those stocks. So you want to buy just the index fund. So you buy the index fund, you've automatically bought all those stocks in the market, and that's it. So you just buy, they pay you a dividend, you buy again, you ignore it. You don't trade, you don't watch the news, you don't care if the market goes up or market goes down. You're buying the index, is cheaper than buying the individual stocks. It's called passive investing. You don't have to wake up at night and like look at Bloomberg. And a good one to buy is the VTI. So that's Vanguard. Vanguard does the VTI. So once you buy the VTI, you've got everything. Keep it simple. Ignore that stuff on TV. Buy, trade, buy, sell. No, just keep it simple. Buy the VTI. Keep reinvesting your dividends and your income, and just let it grow.
That's very interesting. Okay. I would go over the things you mentioned before we talk deeply into that. Okay. Yeah. Somebody even asked a question, which I just want to display also. But just like you said, it's actually about the time and not necessarily about the interest rates, because if you start earlier, you have a good head start, you have more of an advantage than if you start later. And even if you start later with more, it doesn't matter as far as if depending on some of the metrics you gave, it doesn't really matter unless you are actually consistent over time. And for people who are just starting out, the index fund, I know you mentioned the ETF, so the index fund is very important. The S&P, things like the S&P 500, which I believe tracks the top 500 companies in the US, and then the VTI, which is the Vanguard Total Index, which is, I think, tracks the US companies as well. So basically, it's a basket of stocks. ETFs are a basket of stocks. It's basically some of the stocks that are performing well, just into one basket. You are basically investing one amount that covers everything. So somebody mentioned, or somebody asked, with a spare cash of say 10,000 naira. 10,000 naira is, how much is that now? That is around, let me see.
Oh my God.
10,000
Let's not go there.
I don't want to. Okay, maybe let's say $20 to just be.
Yeah, I mean, yeah, and it's a great question because that's really why, like I said, the younger people now are very lucky. So when I started investing, there was no Trove, there was no app, there was nothing. You had to have. My first stock I bought was First Bank, and that was 3 naira 25 kobo. So it looks cheap now, but Coca-Cola was 10 kobo, and
Wow.
one stock of first, it was Standard Bank selling their shares to leave Nigeria, was 3 naira 25 kobo. A lot of money. It's like 30K now. So, but now you can actually buy the VTI ETF with $20, $10, a dollar. You can if you have all those online trading apps, get an account, you can buy those stocks online you can buy fractional shares with $10,
Fractional.
$20. Yeah, and you can just keep on investing. All those stuff, Robinhood, Trove, they're all yeah. So that's why you have a big, huge advantage. You don't have any excuse not to invest. You can set this thing up like automatic. You earn your salary. Your salary goes to an account you're going to create by automatic. So it just goes automatically to your investment account. Then your investment account funds your app. Your app buys the stock. You can put on your app to reinvest dividends or pay your dividends back to your investment account, and you just have a nice cycle going. Don't spend your dividends. Take your dividends, buy the same stock again, so that you are averaging your cost down. So because you are reinvesting those dividends, you are bringing your cost down. So it doesn't matter what they see on TV. Stock is going up, stock is coming down. You don't care. Just buying
Mm.
dollar cost averaging, and you're just buying those stocks. Do it for 10 years. You would be shocked how much you have saved in that portfolio. Yeah. So if you're younger, you have $10. Someone is asking about Tesla. Tesla is part of the S&P 500. So you can just get in and you buy one ETF and you're in. It's risky. But remember what I said, you're worried about inflation and you are younger. So you can absorb that risk if you can, and you have a longer time to recover. The option is to not to buy equities, to do fixed income. So you get your returns guaranteed, but is it going to beat inflation? That's the point.
Yeah.
Even in the US, there's inflation. So we're constantly trying to beat inflation. If there was no inflation, you would simply earn money, put it in the ground, save it in the ground, and when you retire, you just take it out and you spend. So we're investing because we're trying to save the purchasing power of our currency. Just like I said, if the $3, 350 kobo First Bank shares, it's now what about how much? 6 naira or so. But all the dividends and all the bonuses that have been paid from when I bought those First Bank shares has almost made the cost of the First Bank zero. Because when you reinvest the dividends, you're paying off that original cost. So everything is just
Mm.
pure profit for you. So for a younger person, don't try to do this. People come and tell you, oh, let's trade. Let's make 25% in 2 weeks. Ignore all that.
Yeah.
Just be consistent. Just get a budget, do it every month, every 2 weeks, invest, put the money in, reverse dividends, leave it alone. You can have a trading portfolio. Get one trading portfolio. If you hear good news, buy and see if you make money. Maybe 1% of your portfolio, yeah. But the bulk of the portfolio, put it in, invest, and leave it alone.
Mm. Actually, very, very profound. I like that you mentioned, the fact that people cannot buy fractional shares, which sort of means that you don't have to buy, sometimes if you see like a stock is trading for instance, I think Amazon, which if I check, I think is trading for around maybe like $3,000 or something. So you don't have to have $3,000 to laying around. Uh,
Precisely.
so you can actually buy a fraction of Amazon stock. So that's something that you can do instead of just spending $3,000. So fractional shares is actually buying a small portion of the total, and you still get the same. When it appreciates, you still get the same return. And consistency over unnecessary risk. Don't chase like unnecessarily high returns. And like you mentioned, there are apps like Trove, which is actually helping us, make this live session work, which is, I've talked about Trove multiple times on my YouTube channel, and you guys can check the link in my bio. If you download Trove, you can actually get 5 free stocks. Is it stocks or shares now? I think it's the same thing.
I
But
think
if
it's
you
the
get
same thing, yeah.
five free shares of GT Bank and Dangote Sugar, which is around, it should be around maybe like 1,000 naira, something like that. So you can actually get, that's free money that you can get if you download and you get 5 free shares of those. And I like the fact that now we have these tools, because I've also tried to invest in this type of in these things as well, and I've also talked about it on the channel, and I've explained all of that. So one thing I also wanted to talk about was people have mentioned it here, was real estate in Nigeria. I know you mentioned something earlier during this session about people can actually can buy land, and next year it can appreciate to 20%. But what benefit is there when you can get 20% on land, but the currency sort of erodes, the inflation sort of erodes the currency's gain, the currency and your gain. Is it really worth investing in real estate in Nigeria right now? I don't know. Is that something you
Yeah, it's
can?
a good question again. Yeah, so the two questions in one. So like I said, Nigerian investors are really, it's a big problem in Nigeria because you're investing in a currency called the naira, and the naira currency, the purchasing power keeps on falling. So I did a session on inflation. To simply, when there's inflation, you first of all have got to meet inflation. First of all, I get the example of a guy that if you were earning 100,000 naira a decade ago, say in 1990, and you earned 100,000 naira for 10 years, by the 10th year, your salary was 38,000 naira. That's what you actually earned, 38,000 naira. If you just did the inflation rate of just 10%, not just the 10%, so 38 grand. And how many people have gotten the salary rate in Nigeria right now? Not a lot. So it's a disincentive to invest in. But you see the problem, the good thing is this. If you buy property, you are going to sell and you're going to value at the inflation plus rate. So inflation, buying land, buying a property, buying any commodity that the price is going to be priced at the selling price, not the cost price. That's where you want to be in. When you hold Naira, the paper doesn't has 10 Naira, 20 Naira on it. You can't change it. You can't rub off the 10 and put 50. So that means you are always carrying that cost at the price you bought it. That's the problem with Naira. You can't change the currency on it. But if I buy land for 1 million, if I want to sell, I'm selling at the price for today. So it captures inflation in, and I'm able to absorb that increase in cost. So commodity, if you buy cocoa today, or if you bought cocoa last year and you want to sell cocoa today, you're going to sell at the current price today, not the price you bought it a long time ago. So commodities, gold, real estate, those give you a better hedge against inflation. Someone asked a question here. I'll just make sure I answered it. That if you're doing an emergency fund and you have to save in currency, right, in naira, but there's inflation, should you invest the naira? The answer is no. Your emergency fund sadly is going to be affected by inflation, but your emergency fund is your cash or near cash savings. It's what we call your bottom box. If something happens to you, that's where you run to and get the money out. So sadly, you just have to keep on putting more and more money in because you are saving. I didn't give you an amount. I said save 3 to 6 months of your necessary savings. So if your rent goes up, you have to increase the emergency fund. That's basically what it is. If fuel price goes up, your emergency fund has got to go up. So you want to save 3 to 6 months of your necessary savings, because when inflation takes those prices up, you also have to go to your emergency fund and also take it off.
Interesting. So basically, guys, commodities, things like real estate, buying it, you buy it at today's price, you're selling it at that day's price. Cash, if you hold cash, you are sort of holding it at the price you got it, at this. Is it the buying price now?
It's
Regardless of,
historical. It doesn't change. It's whatever you hold, what you have.
rub off the value of 20 naira off of the 20 naira notes, or the 20 naira sitting in your no interest account, or maybe the one that is charging you for using it, which is a lot of them. Okay, so People are asking me about risks, and there are two questions I have here. I would go ahead and display one. Someone asked about meme stocks. Then another person also asked about stocks that stocks can lose value over time, and how do we mitigate the risks of stocks losing value over time? And maybe we'll also touch on things that are sort of stable, like ETFs as well, which, I mean, none of them, they're not stable. I wouldn't say they're stable per se. And then somebody also asked about domiciliary accounts. Just basically, maybe is it trading currencies now? Is it better to sit in a domiciliary account, or is it better to use it to trade? So basically, the risk question, and basically saving in another currency.
Great questions again, yeah. So meme is just what we call momentum. So it's just momentum. It's just the hype stocks. They are only good if you're trading. So this is what's going to go into your 1% portfolio. You have your 1%, I can lose this money portfolio. So if you want to buy all those AMC, all that kind of stock, that's where you put it in and you trade. They have no value. Those stocks are dead. There's no fundamentals behind those stocks. Like Hertz was bankrupt, but the share price was going up. I want people to understand what I mean. When a share is bankrupt, it means it's worth zero, not zero, minus zero. But the shares were going up in price in the market because people didn't care, because they had stimulus funds and they were at home, they were bored. But you don't want to invest in those stocks and hold them because they are worthless. So you can buy and trade in your 1% trading portfolio. So just a hype stock. So be careful about not buying and keeping those stocks. They are worthless, right? What about stocks can lose value? Yes. Remember we said there's fixed income that you're sure of what you're going to get. Then stocks are what you call variable income. You're not sure of what you're going to get. The reason why we're doing stocks is because stocks over time can or have proven to have beaten inflation. It's not guaranteed, but over time, stocks could return you a return that can beat inflation. And if you're younger, we want to appreciate the capital, not just preserve the capital. That's what you're doing stocks, right? So it's more risky to invest in equities, but you're younger, you can absorb that risk, and you're trying to have the objective of accumulating assets. That's why we're doing stocks, right? So nothing is stable. No investment is stable. Even the US, the most stable investment in the entire world is the United States 30-year or 10-year treasury bill, right? That's the safest investment in the entire world. But if you buy that investment, yeah, you're going to earn about 0.15 or so. That's what you're going to earn, or zero. Right now, the US is paying zero. If you buy a Japanese bond, you earn negative. So you pay the bank to buy the bond. If you buy a Euro bond, you earn negative. So it's really your call. If you want to earn negative and sleep at night, or you want to earn maybe 5% and not be asleep at night, it's your call. You have to choose which one that you think you prefer, right? Then domiciliary accounts, remember, right? When you hold a currency, the currency itself is just paper. You only appreciate the currency based on the interest that is paid to you, right? So if you hold dollar and the dollar pays you 1%, that means, look at it this way, that you're investing in America. American is paying you less than 1%. So if you have a DOM account that's going to pay you 1%, grab it, because when you hold a currency, you are literally in that country. So if you're holding dollars, you're in America. That means that DOM account is an embassy, and you're putting your money in that embassy. So the embassy is going to pay you 1% for the same dollar amount. Great. The only thing is, what if when you want it back? I hope they can give it back to you. That's just my only comment. But if you want to save in dollars and not naira, it's a good strategy. You want to diversify your currency, diversify your location you're investing in, and diversify your geography. So diversification is a big thing. You want to make sure you're diversified across all those three.
Okay. So just to summarize, stocks, while they are not guaranteed or stable per se, they are very good for hedging against inflation. and also the interest that they help you bear. And yes, having dollars can help you diversify, and even as little as 1% is also very, very beneficial. So we also have a representative from Trove here as well. So hi, Ben. He's going to just give us a little bit about how Trove helps in all of this things, helps us invest in stocks, and how we can also take advantage of some of the things you mentioned, like, not just having an emergency fund, also having equities. At the age that we're in, the major age range is that 18 to 25 and also older. How can we take advantage of some of the benefits that Trove has? What are some of the benefits that Trove has that we can take advantage of? And just tell us a bit about that.
Great. Great to see you, Kalu. Thank you so much for granting us audience. You really have done a lot in explaining, making it very simple, because one of the challenges that we know we have in this age, just like Fisayo said, we have a huge chunk of 18 young people, 18 to 35, 40, and a huge number of those young people, even the 18 to 25, don't still know that, they have access to, such opportunities in this time. Just like you were explained during your time, there were not things like this, So basically, what Trove does is Trove gives access to young Nigerians and Africans to access the local and foreign stock market just from a tap of your phone. I know that Kalu is a big fan, and someone that uses the platform, and he can also testify to how functional the platform is, and a lot of people, presently we even have a campaign ongoing. We're giving out $100 to people who are using the platform. Basically, what you need to do is just to record a 30 seconds, testimonial of you using the platform. We have some people who have sent entries, and we are compiling presently. I think it's something that, everyone that is joining and people who are not even here can tell their friends to do. It's basically you just download the app on the Play Store or the App Store, and fund your account with as little as $10 to access foreign stocks, and $1,000 to access local stocks. And you just send in your entry, of you funding your account, sharing your experience of how seamless the platform is, and you stand a chance to win $100, to even help your investment become better. So basically, Trove is a platform that, especially young people, because this platform is built, to actually help young people build wealth from the very young age, just like what Carlos said earlier. And and I think that every young person, because I'm young, I'm also very passionate about this, and I think that it's something that every young person should be part of. So starting with the $100, you could just also be part of that and share with your friends. Check our handles and you'll find more information there. Thank you so much.
How many people can win this $100? Because I'm interested.
Oh, awesome. Great. Everyone can actually win. Everyone,
No, how many? Is there a limit?
So for now, it's an 8-week campaign, and so we are picking one person per week. So it's just basically, you record yourself, talk about how your experience has been using the platform, and you send that 30 seconds, 50 seconds, a minute record to us, and we post on our platform. So the user with the highest number of views and engagement on their testimonial, wins $100. It's as simple and easy as that.
All right, thank you so much. I really appreciate you explaining the platform and also talking about this opportunity. for people to also benefit from something like this. Today we're like, again, like I said, we're talking about how we can, better ourselves with, learning finance or becoming much better or a little bit enlightened and educating ourselves. And one thing that Kalu mentioned that I really like is investing in yourself. And things like this also help us to invest in ourselves, building your knowledge, and just reading stuff, learning stuff. I think that's, you can't really take that away from the investing in yourself part. So is there any resource, Kalu, is there any resource that you would recommend people check out for investing if they want to learn more about investing, if they want to become better at it? Are there resources that you can point to, maybe like 2 or 3 resources that have helped you or can help people on this live session right now? And that's the last question I have for you.
Yeah. I mean, it's there's tons of stuff on YouTube and online. So I like fool.com. Like in the name FOL, fool.com is very good. The guys, I think guys are they're pretty good, and they talk they're equitable. Investopedia is very, very good also to learn. So like how I learn stuff was when I see things I don't understand, I go to Investopedia because they will tell you what it is and give you tons of articles. So anything you spend time on and study, become an expert in it. So if you don't understand stuff, just go to Investopedia and read up, fool.com, and then just get I personally listen to a lot of podcasts and all that. Audible, I get Audible and I listen to Wall Street Journal, Bloomberg every morning. Just wear your headphones and go to work and listen. You just have to um, be in the mood to want to learn. The same way, if you ask any Nigerian guy, standard Nigerian guy, to name not the first 11, the second 11 of Arsenal, they will give you that. Not for this year, for say 1985, they'll give you the second 11 of Arsenal because they're interested in it. So the same thing you have to be in. If you whatever you're interested in, you will become an expert in. Yeah. Just asking, this lady has been asking for a long time, how can we recover from losing multiple investments? The first thing is not to invest again. The second thing is, I think you should go to court. I think many people waste time on social media trying to shame those guys. Those guys they're criminals. Yeah. First thing you do not ever invest in any investment that doesn't have, you can't locate the office or don't have a license. But once you lose money, get a lawyer and immediately file. Don't talk to social media because you want to make sure you can get a hold of the asset that the person has and just grab it. So get an association, get a lawyer, and go after the person. Yeah.
Okay. So I think that's it. We're already in the conclusion phase of this session. So thank you so much, Kalu, for your time again. I'll just use this part to go over all of the things that you have mentioned. One of the things that we should recognize is who we are, how old we are can also kind of affect the risks we take. And if we live in Nigeria, we should definitely pay attention to the inflation. We should have an emergency fund, which is very important. If you're married or you have dependents, get life insurance. And, at this age that we're in, take larger risks, equities, which tend to have a better return that can help you beat the inflation over time. And consistency is very, very important. If the older you go, the more you can lean towards things like fixed income and very, 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 very little exposure, maybe like 1 to 2% in cryptocurrency. We wanted to talk about cryptocurrency, but unfortunately the time doesn't really help with that. But I'm sure people can check out. Please, guys, make sure you check out Kalu on Twitter. I follow him there. I read almost every tweet because your tweets are very, very insightful. I really check them out and just I remember, and I know I didn't say that, I haven't told you before, you probably don't know, but you made a tweet where a couple of people were replying about Ponzi schemes. And it went crazy. I'm sure you had millions of impressions on your end, or over 1 million impressions, but there were so many responses that I had to just make a video. I referenced your tweet in that video, and it kind of helped me get sort of a better understanding because I read so many articles and I started reading a lot of things about Ponzi schemes and how people get into Ponzi schemes and things like that. So yeah, please just check out his Twitter handle. You can also check out my YouTube channel for videos. It's the link in my bio. I'll also put the link to his Twitter handle after this recording is done as well. So again, he also mentioned for the US, things like credit cards, 401ks, Roth IRAs, and saving, for saving, once you've earned and you don't spend, what you've kept is what you've saved. And investing is taking your savings and deploying it to get returns. Now, consistency again, it's actually better to compound over time and not chase over very high interests that might be Ponzi schemes or things that are very, very volatile. So start early, because the younger age sort of gives you a good head start and some advantage. And again, consistency over unnecessary risk. Consider things like real estate as well. Stocks, while they are not guaranteed or stable, you can give you a good interest that you can use for hedging against inflation. And it also makes sense to expose yourself to dollar, and it's a good way of diversifying. And some of the resources you mentioned, fool.com, I believe that's monthly fool. Is that correct? So
Yeah.
fool.com, that's FOOL.com. Audible.com for audiobooks. You can get some very good books. I think there are some books that I also talk about there, like The Psychology of Money, the Millionaire Next Door, things like that. There are so many very, very good books. Is there any of your favorites, Kalu? Is there any one that you really like?
Yeah, that's one. Invest like, think like, what's the title again? Invest like Warren Buffett and think like Bill Cunningham, I think. Yeah, that's a book yeah. But if you want to really, it depends on I like Warren Buffett's, the way how he thinks about investing. So if you can get any book on Warren Buffett, how he can price a stock and get intrinsic value and his mentality, that's a good place to start.
Okay. And Investopedia as well is another resource you mentioned. And also, guys, make sure you check out Trove. Trove has a campaign for $100 for 8 weeks. So every week for the next 8 weeks, or there'll be an announcement for that. Anyway, we'll wait for an announcement on Trove.
The next. I mean, it's the campaign. It's already started, so it's on the platform. Okay. Yeah, it started 2 weeks ago. So yeah, I mean, that's 2 weeks. That's next 6 weeks from now.
Oh, okay. So yeah, so $100 every week. Make sure you key into that. Please check the link in my bio. I have plenty of things linked in my bio. There's just a link with many other links. So when this live session is saved, we would have Kalu's Twitter handle in the description. But you can just check out, just search for the name and you'll find it on Twitter. Look for the one that has the most followers. Anyway, thank you so much. This was insightful, not just for me. I'm sure it was insightful for many of the people that were on this call. If you learned something, you can just put a thumbs up in the comment section of this session. Just do a thumbs up if you learned anything at all. Just do a thumbs up. And yeah, with that, we have come to the end of the session. Thank you again for your time. Thank you, Ben. Thank you, Kalu. This was insightful, and I will go over the session. When it's saved, I will also watch it and learn something. Well, I've made some notes. So thank you again, and we'll see on the other side. See you in real life.
All right, guys, take care now.
Thank you. All right.